Imagine you need money, a lot of it, maybe to start a business or build a bridge. You could borrow from a bank, but what if you need even more than they can offer? Banks have their limits, and sometimes the amount you need far exceeds what they are willing or able to lend. This is where bonds come in. A bond is essentially a loan, but instead of borrowing from a single lender, you borrow from many individuals or institutions. Think of it as crowdsourcing your loan. You issue bonds, each representing a small portion of the total loan. When you buy a bond, you're lending money to the issuer, be it a government, a corporation, or even a city. In return, the issuer promises to pay you back the principal, the original amount you lent, on a specific date called the maturity date. They also agree to pay you regular interest payments known as coupons for lending them your money. These interest payments are typically made semi-annually, annually, or at other regular intervals, providing a steady stream of income for the bondholder. Bonds are appealing to both borrowers and lenders. Borrowers can access large sums of money that might be difficult to obtain otherwise. This is particularly useful for large-scale projects like building infrastructure, funding government operations, or expanding a business. Lenders, on the other hand, receive a relatively predictable stream of income through interest payments. This makes bonds an attractive investment for those looking for stability and regular returns, such as retirees or conservative investors. However, like any investment, bonds carry risks. The issuer might default on their payments, meaning they fail to pay back the principal or the interest. This risk is higher with corporate bonds compared to government bonds, which are generally considered safer. Interest rates might also rise, making your bond less valuable. When interest rates go up, new bonds are issued with higher coupon rates, making existing bonds with lower rates less attractive. This can lead to a decrease in the market value of your bond if you decide to sell it before maturity. Despite these risks, bonds have played a crucial role in financing everything from wars to infrastructure projects for centuries. They have been a reliable source of funding for governments and corporations alike, helping to drive economic growth and development. Understanding how bonds work is essential to grasping the complexities of the financial world. For instance, during the 2008 financial crisis, seemingly safe bonds tied to the housing market triggered a global economic meltdown. Bonds that were thought to be low risk turned out to be highly volatile, leading to massive losses for investors and financial institutions. This event highlighted the importance of thoroughly understanding the underlying assets and risks associated with bonds. In conclusion, bonds are a fundamental component of the financial system, offering a way for borrowers to raise significant amounts of money and for lenders to earn regular income. However, it's crucial to be aware of the risks involved and to make informed investment decisions. Whether you're a seasoned investor or just starting, understanding the basics of bonds can help you navigate the financial landscape more effectively and make better investment choices. So the next time you hear about bonds, you'll know that they are more than just pieces of paper. They are powerful financial instruments that have shaped economies and will continue to do so in the future. The concept of borrowing and lending is as old as civilization itself. From the earliest days of human society, people have found ways to exchange value and secure resources for future repayment. This fundamental economic activity has evolved over millennia, shaping the financial systems we rely on today. Some of the earliest evidence of bonds dates back to ancient Mesopotamia, where clay tablets recorded loans secured by agricultural commodities like grain. These records, etched into clay, were the precursors to modern financial contracts, detailing the terms of the loan, the parties involved, and the repayment schedule. They provide a fascinating glimpse into the economic life of one of the world's earliest civilizations. These early bonds were a far cry from the sophisticated financial instruments we know today, but they laid the groundwork for the development of credit markets. The concept of lending with the expectation of future repayment, often with interest, was revolutionary. It allowed for the accumulation of capital and the funding of larger projects, which in turn spurred economic growth and development. Fast forward to the Italian Renaissance, where city-states like Venice and Genoa issued bonds to finance their burgeoning trade empires. These bonds were not just simple loans, they were complex financial instruments that could be bought and sold, creating a secondary market. This innovation allowed merchants to manage risk and liquidity more effectively, facilitating the expansion of trade and commerce across Europe and beyond. These bonds were traded among merchants, creating early forms of secondary markets. The ability to trade bonds meant that investors were not locked into their investments and could sell them to others if they needed cash. This liquidity was crucial for the functioning of the market and encouraged more people to invest in bonds, knowing they could exit their positions if necessary. The development of printing presses in the 15th century made it easier to standardize and disseminate bond certificates, further fueling market growth. Printed bonds were more uniform and easier to verify, reducing the risk of fraud and making it simpler for investors to understand what they were buying. This standardization was a key factor in the growth of bond markets as it increased transparency and trust among investors. As nations rose and empires expanded, governments increasingly turned to bonds to finance wars and other large-scale projects. Bonds became a vital tool for raising large sums of money quickly, allowing governments to undertake ambitious endeavors that would have been impossible to fund through taxation alone. This reliance on bonds also meant that governments had to maintain the trust of their investors, leading to more sophisticated financial management and oversight. The Napoleonic Wars of the early 19th century, for example, were largely financed through bond issuances, as were the American Civil War and World War I. These conflicts required enormous financial resources, and bonds provided a way to mobilize those resources quickly. The success of these bond issuances demonstrated the power of financial markets to support national efforts, even in times of crisis. These conflicts spurred the development of more sophisticated bond markets, with institutions like central banks playing an increasingly important role. Central banks began to act as intermediaries, buying and selling bonds to manage economic stability and control inflation. This intervention helped to stabilize bond markets and made them more attractive to investors, further driving their growth. The 20th century witnessed the rise of the modern bond market. With the advent of new technologies and the globalization of finance, bond markets became more interconnected and complex. Investors could now buy and sell bonds from around the world, diversifying their portfolios and spreading risk across different markets and sectors. Technological advancements like telephones and, later, computers facilitated faster and more efficient trading. The ability to communicate instantly and execute trades electronically transformed bond markets, making them more dynamic and responsive to changes in economic conditions. This increased efficiency also lowered transaction costs, making it easier for more people to participate in the market. New types of bonds emerged, including corporate bonds, municipal bonds, and, critically for our story, mortgage-backed securities. These new instruments allowed for even greater flexibility and innovation in financial markets. Corporate bonds provided companies with a way to raise capital without issuing stock, while municipal bonds funded public projects like schools and infrastructure. Mortgage-backed securities, meanwhile, transformed the housing market by allowing banks to bundle and sell mortgages as investment products. These innovations, while seemingly positive, set the stage for both unprecedented economic growth and the potential for catastrophic collapse, as the events of 2008 would soon demonstrate. The financial crisis of 2008 highlighted the risks inherent in complex financial instruments and the importance of regulation and oversight. It served as a stark reminder that while financial markets can drive economic progress, they can also lead to significant instability if not properly managed. In the decades leading up to the 2008 financial crisis, a new breed of financial instrument gained immense popularity: mortgage-backed securities, or MBS. These financial products were initially seen as a brilliant innovation, a way to spread risk and provide steady returns to investors. But as we would later find out, they also had a dark side. Imagine a giant pot where thousands of individual mortgages are thrown in together. This pot is a mix of different types of home loans, from those given to people with excellent credit to those with less than stellar financial histories. This pot is then divided into smaller portions, much like slicing a cake. Each slice represents a piece of the overall mortgage pool, and these slices are what we call mortgage-backed securities. Each slice represents a mortgage-backed security. These securities are then sold to investors, who are essentially buying a piece of the action, betting on the ability of homeowners to repay their loans. Investors buy these MBS slices, essentially betting on the ability of homeowners to repay their mortgages. The idea was that by pooling many mortgages together, the risk of default would be spread out, making the investment safer. As homeowners make their monthly payments, the money flows through the MBS system and is distributed to the investors holding those particular slices. This flow of money was supposed to be steady and predictable, providing a reliable income stream for investors. Seems simple enough, right? The concept was straightforward: diversify the risk and everyone wins. But here's where things get tricky. To make these MBS more attractive to investors, they were bundled together based on their perceived risk. This process, known as tranching, created different levels of risk and return within the same pool of mortgages. To make these MBS more attractive to investors, they were bundled together based on their perceived risk. The idea was to create different levels of risk and return so that there was something for everyone, from the most conservative investors to the most aggressive. The safest slices, filled with mortgages from borrowers with good credit scores and a history of timely payments, were deemed low risk and received high ratings from credit rating agencies. These high ratings made them very attractive to conservative investors looking for a safe place to park their money. These agencies, like Moody's and Standard & Poor's, played a crucial role in assessing the riskiness of these complex financial products. Their ratings were trusted by investors around the world, and a high rating from one of these agencies could make or break an MBS. The problem was that many of these MBS were stuffed with mortgages that were anything but safe. As the demand for MBS grew, lenders began to lower their standards, offering mortgages to borrowers with poor credit and little documentation. These were called subprime mortgages, and they were riskier, but they were also more profitable, and they allowed lenders to create more MBS to meet the growing demand. These subprime mortgages were ticking time bombs, and their inclusion in seemingly safe MBS would prove to be a recipe for disaster. When homeowners began to default on their loans, the entire system started to unravel, leading to the financial crisis of 2008.